Hey everyone, it's Wolfgang. I want to talk about getting past the fear to buy a property. This is concerning borrowing, getting a loan. If you're thinking about getting a loan to buy your next property in your real estate career, this is for you. There's a lot of us who are in this boat right now at the exact same time because of what has happened recently. So recently there's been an interest rate shock. Interest rates were, there was the zero interest rate policy, ZIRP, zero interest rate policy, starting in 2008. It lasted all the way into 2020, 2021. Interest rates started going up in 2022. So it was a good run of about 14 years of zero interest rate policy. A lot of people took out loans during that time period at 3%, 4%. You could get loans that low if you were buying rental property. And the thing that most people don't know, there's a difference between single-family homes, condos, townhomes, 1 to 4 units. That's one type of loan. Fourplex, triplex, duplex, single-family homes, condos, and townhomes. That's one type of loan. That's a residential loan. Once you get to 5 units or more, it's called a commercial loan. So with home loans and 1 to 4 units, those are 30-year loan terms. They amortize over 30 years and they last 30 years. Once you get to commercial loans for larger properties, 5 units or more, those loans they're amortized over 30 years, but they're due in 10 years. And some of them can start adjusting and become variable interest rate loans in as short a time as like 3 years or 5 years. During this time period of the zero interest rate policy, everyone felt pretty safe about taking on a riskier loan like that would convert to a variable rate loan, because the Fed at that time was telling everyone we're not going to raise rates for a long time. So people felt safe. A lot of people took out loans, risky loans too, and now they cannot roll over their loans. Interest rates have jumped to 7%, 8%, 9%, etc. We all know that. And so there's been interest rate shock and a lot of foreclosures. So here's what happens. The bank says you now need double the net operating income you had when you took out the loan that it has come due. Because a lot of owners, general partners and owners, when they took out loans during this period, the zero interest rate policy, those loans came due after interest rates spiked starting in 2022. And the bank told them, because of the new higher interest rates, to qualify for the loan, because of the debt service coverage ratio, DSCR, look that up. I've covered that in other videos, a couple of other videos on my channel. You can just look on my channel for DSCR, and I think there's a couple of videos there. But the bottom line is the bank told the general partners and the owners, in order to roll over your loan and get a new loan, you need double the net operating income. Do you have that? Have you been able to raise the rents enough, right? And here's what the general partner and the owners told the banks. No, rents have not gone up enough to generate a double of the net operating income. A main reason for that is the inflation we've all had has doubled our expenses for labor, for materials, for vendors that need to be hired to maintain the properties. And the owners told the banks, our net operating income has actually flattened or gone down because of the inflation. And here, Mr. Banker, are the keys to the property. We're walking away. We're getting foreclosed on, right? So some lenders did what are called workouts because they don't want the property on their books. If the lender was able to do a workout with the loan, come up with some negotiated new contract that would allow the existing owner or general partner to keep the property but still continue paying on the loan, some lenders did those workouts. They didn't want the asset on their books. Because lenders are not in the business to own property that they're now tasked with selling or renting out. Lenders are in the business of making loans. They don't like having properties on the books. So some lenders did workouts, but many lenders did not. They were just not able to, and they had to foreclose on the property and then dump them on the market at a low price. So keep this in mind. The lenders who did not do the workouts and had to foreclose on properties, they still need to get those properties off the books of the lender. They have to dump the property on the market at a low enough price to attract a buyer. And that's why a lot of properties have been available for pretty cheap. That's going to lead into something I'm going to talk about, because the whole objective of this video is to get people past the fear of continuing on with the real estate career, getting past the fear of taking on debt to buy that next property. So there is some fear about buying real estate because of all the foreclosures, because of the interest rate shock. And so we want to talk about what is a rational career move for people who are in this boat. Idea number one, and a lot of people are doing this. This is happening around the country now. Vulture investing. Some owners have impending loan maturities. If you do a search online for list of real estate owners with impending refinance, there's a lot of sources of that data. So you can contact those owners and tell them, look, we know you have a refinance coming up. We know your existing loan is low. We know inflation made your expenses skyrocket. We know your net operating income is not going to allow you to refinance. We know you're probably going to get foreclosed on. We will buy the property from you at the cost of the existing loan, and you won't make any money, but you will avoid the reputational damage and the credit hit of the foreclosure. So a lot of sellers, a lot of property owners have been taking them up on those offers to get out from under the property. The interest rate shock made it impossible to roll over the loan. Let's get rid of the property. They've got two choices. Either the bank takes it back and our reputation in our career is destroyed and the credit's gone, or we can sell the property now and not let the bank get involved. And maybe we don't make any money on the deal, but at least we've salvaged some of our reputation. We took the better of two bad options. We sold the property. So vulture investing means contacting those owners, and in some cases, the owner does make a little bit of money, but they avoid the foreclosure. And this is doable with residential rental property, but not so much with office property. And the reason is the work from home trend sort of got rid of a lot of office tenants. So a lot of office building owners lost tenants because the tenants had workers who were working from home, and they didn't need to be tenants of the owner of the office property. So this idea is best used for residential property. Right now, banks have taken back so many office buildings. You can look online. You can find properties that sold just a few years ago for like $300-400 million, and they just sold for like $20 million. It's crazy, and it's because the office net operating income is gone. All the tenants are gone. The work from home killed the damaged the office real estate market. So that will recover eventually, but I think it's going to be a long time. So with vulture investing, we buy the property for a discount, we hold, and then refi when rates drop and when the economy improves. The economy will improve. It's still tough out there. There have been a lot of layoffs, and I don't know if anyone's paid attention, but it has become clear that the data, the jobs data that was being given to the Fed over the last, before the election was bogus. Apparently it was, and actually a lot of people already knew that because not too long ago, a few months ago, they announced like 812,000 jobs that had previously been claimed to have been created, actually had not been created. So everybody took notice of that and said they're fudging the jobs data and giving fudged data to the Fed. Why were they doing that? You can speculate on why they would be giving bogus data to the Fed. We have talked about it, and we are somewhat convinced that the gravy train of pennies on the dollar office properties was a motive for someone to pay off the companies who were giving the data to the Fed to keep reporting good job numbers so the interest rates would stay high, to block the refinancing of the office properties. In other words, another kind of vulture investing where they're fudging data to the Fed so interest rates stayed high. So the bottom line is I got off on that tangent because we all know the economy is still kind of weak. We're hoping we'll see a recovery. Okay, so the objective of this video was to get people over the fear of buying a property. This is one way you can do some good for some owners and get a bargain property, a residential rental. I don't recommend office, residential rental. Another idea is to get over the fear of buying your next property for your career is raise a low loan to value fund or purchase your next property and have a low loan to value. In other words, loan to value means how much of the loan, how much of the value, what's the ratio. If you have a 60% loan to value, that means the loan represents 60% of what the property is worth. Normally, you could buy property for up to an 80% loan to value. In other words, you buy the property and 80% of the money is borrowed. So you're subjected to some risk. There are two risks you're subjected to as you increase the amount of leverage. When you take on a higher LTV loan, you're taking on a larger loan, you're taking on two additional risks. Interest rate shock, we all know what that is now, and the inflation risk. that is very hard to predict. The interest rate shock was arguably very predictable because we had already been in zero interest rate policy for 10 years, and these people were still taking out these loans thinking this was going to go on forever. At the end of 10 years, all you had to do was look at historic data, and if you're in this career, you should look at the historic data and say to yourself, there's never been a time in history that we've been at zero interest rate policy for 10 years. I'm not going to take a high LTV loan. I'm going to take a low LTV loan. So that's what this idea is. To get you over the fear of taking out a loan to continue with your real estate career is to buy a low loan to value property. In other words, you're using less leverage. Yes, you're putting up more money, a bigger down payment, 40%, obviously, 40%, but limited partners are really ready for lower risk real estate due to the recent losses. A lot of limited partners have to put investment dollars to work. Pension funds, wealthy individuals, hedge funds. There are a lot of limited partners who are still going to invest in real estate. They are ready for lower risk real estate because of the recent losses, the recent foreclosures. So if you have a low loan to value purchase, low leverage, you are insulated from those two risks, inflation risk and interest rate shock risk. And so the marketing for this idea would be our fund uses no more than 60% leverage, loan to value. So those are two ways to get over the fear. You don't stress yourself out by over leveraging, and you help out some people who need to offload their property before their reputation, their career is trashed due to a foreclosure. Okay, so what are the lessons for the future? We've all seen a lot of properties being taken back by banks. Number one, zero interest rate policy was 10 years old in 2018. In 2018, ZIRP was 10 years old. They should have known. I don't think there's any excuse for it. Even if you were new to the industry, it doesn't take much thinking to realize, wait a minute, we've had 3% interest rates for how long? 10 years? Interest rates are probably going to go up here pretty soon. And they did. And they went up very fast. Pay attention to inflation risk in the economy. And the way you can track that is track government spending. If the government is buying a lot, if the government is doing a lot of spending, that makes things more expensive generally. So pay attention to the inflation risk. If the Fed has loosened monetary policy, if the Fed is making it trying to stimulate the economy with stimulative monetary policy, that can create inflation too. Pay attention to inflation risk and pay attention to where we are in the interest rate cycle. And never allow your confidence to be dinged by over leveraging. The people who this happened to, the vulture investing, the people were saving by buying their properties, their confidence is dinged. And you don't need that. I mean, the whole point of this video was targeted at people who have dinged confidence. Their confidence has suffered a little bit because of all the foreclosures. So you can still keep your career going. You just need to be a little more conservative economically. Financially, you want to use less leverage, and you'll feel better about things. You'll say to yourself, I've got a 60% loan, and even if the economy softens, and even if rates go up, I'm still protected. I still have that margin of safety that Warren Buffett likes to have. So I hope this helped. A lot of people are in this boat. They want to keep their real estate career going. Very afraid about the debt market, taking on debt because rates are high and so on. But there are a couple ways around it. Vulture investing and low loan to value purchase. If you have any questions about either of these, please ask questions in the comments and I'll try to get to those. And I really want to thank everyone for watching and have a great day.